With the White House finally rolling out tariffs and everyone giving their opinion on what the long-term effect is going to be on all of us, the only thing they've managed to produce so far is a very volatile market. In today's video, we're going to break down what a tariff is and give you everything you need to know in order to successfully navigate a world where you'll have to be a more informed consumer. First, let's define a tariff. Tariffs are taxes charged on goods imported from other countries. The companies that bring the foreign goods into the country pay the tax to the government where they're being imported. President Trump says he's implementing tariffs to curb the flow of illegal immigrants and illicit drugs into the United States, as well as to help domestic manufacturing. He's trying to improve the U.S. trade deficit for goods. That figure hit $1.1 trillion in 2024 as Americans bought imported products and a strong U.S. dollar weighed on exports. The U.S. has run a trade deficit every year since the 1970s. This chart showcases the trade deficit. Economists believe that a high trade deficit may be a sign of U.S. economic strength, as it shows that we're buying. But the figure is nonetheless why tariffs are a central part to Trump's economic agenda. Other countries rely on global trade far more than us, and Trump aims to leverage America's economic strength as a tool to achieve a more balanced relationship with our trading partners. Look at this graph that shows the imbalance of tariffs with large trading partners. Trump aims to rebalance tariffs between the U.S. and other countries to make them reciprocal. The White House's latest tariff announcements on April 2, 2025 marked a sharp escalation in trade protectionism, with a new 10% baseline tariff on most U.S. imports and additional reciprocal tariffs pushing the weighted average to an estimated 20 to 25%, significantly higher than market expectations. On April 9, 2025, Trump announced a 90-day pause in tariffs for over 70 countries while negotiations take place. While negotiations could bring these rates down, tariffs at elevated levels introduce new risks to growth, inflation, and corporate earnings. One thing is for sure: the president's on-again and off-again approach to the use of tariffs has made markets at home and abroad very volatile. Take a look at this. When the tariffs were announced, the market went into freefall, dropping 10% in 2 trading sessions. And then, when the tariffs were paused, the market went on a tear, up 9.5% in one day. So you may be wondering, why have tariffs affected the stock market? Or maybe, how do tariffs affect the stock market? So let's show you this image as we have data from Trump's first term, where he implemented tariffs for the first time in over 100 years. Investors may be experiencing deja vu as tariffs make headlines. The first Trump administration's tariffs on China sparked a trade war that whipsawed markets and dominated the news, much like now. How did the markets respond? Volatility rose in 2018, driven by the trade war and a slowdown in China's economy, causing the S&P 500 to fall 18% in the fourth quarter and 4.4% overall for the year. But the index recovered sharply in 2019, up 31.1% as trade deals were announced and consumer spending remained steady. In both years, inflation was muted in the aggregate, with the annual consumer price index ranging from 1.5% to about 2.8%. The S&P 500 returns during his first term were 13.2% per year. So despite the tariffs, the markets did well. They did so well, in fact, that President Biden kept many of them in place, and the S&P 500 during his presidency was about 13.1% per year. So what should you do about all this? Logically, one might conclude that these pro-U.S. trade policies would benefit U.S.-based companies. It would be easy to think that you should load up on U.S.-based investments. And if you did that, you would be wrong. Ironically, the international investments have been handily outperforming the U.S.-based investments in the first quarter of 2025. Take a look at these numbers. Global real estate, international developed, international small cap, emerging markets have all been outperforming their U.S.-based investments, both the S&P 500 and the Russell 2000. And a globally diversified portfolio is holding up quite well. And the point of showing you this is that as tempting as it is to dictate your investment policy based on current events or political bluster, That's a fool's errand. The best defense against the known unknowns from Washington, D.C. is to remain diversified. Who would have thought that heading into 2025 with the international investments, which have lagged the U.S.-based investments for many years, that they'd be outperforming in a political environment that's clearly pro-U.S.? Nobody. It goes to show you that no one can predict anything. If they could, they would have told you to go all in on the international investments in January 2025. You won't find those articles or videos because they don't exist. What I'm here to tell you is to embrace the unknown. What history tells us about uncertain times is that it's the best time for fraudsters to profit. They know that people are feeling fearful and are eager to separate a fool from his money by telling them about a sure thing investment. History has many lessons, and we also know that uncertain times are the best times to invest. In fact, Warren Buffett says the best time to invest is when there's blood in the streets. And while we don't believe there's blood in the streets yet, there could be opportunities on the horizon. So be ready. If you'd like to talk to us about how to be ready for the next big investing opportunity, use the link below. We're happy to help guide you and navigate you through this process. Also, if you like the content that you see here, like and subscribe to the channel, share with anyone who you think can benefit, and we'll see you on the next one.